Something is shifting in Washington slowly at first, then with a force that feels unstoppable. It's not a siren-blaring invasion or a cyber attack lighting up cable news. No, it's something quieter, harder to see, and infinitely more dangerous. Beneath the surface of the U.S. economy, a pressure has been building, unseen by most, but unmistakable to those watching the bond markets. The tremors didn't start with missiles or military maneuvers. They started with numbers, subtle at first. Treasury yields began to rise, barely noticed. Then all at once, they surged past 4 and 5%. To the average person, that number meant nothing. But inside global financial circles, alarms began to scream. Foreign investors started backing away. Treasury auctions went ignored. What used to be considered the safest asset in the world was suddenly radioactive. On Wall Street, the atmosphere turned electric with fear. Phones lit up. Trading floors buzzed with panic. Rumors spread faster than facts. This wasn't speculation anymore. This was contagion. And then, without warning or fanfare, Washington blinked. No televised address. No official rollout. Just a quiet reversal of years-long trade policy. Tariffs on Chinese imports, electronics, machinery, EV components were suddenly gone. The move was swift, silent, and astonishing. For an administration that had stood unyielding on China, it felt like a capitulation. But beneath the sudden policy shift was a signal. The ground was shifting too fast to stand still. Something was wrong. Officials claimed the tariff rollback was about fighting inflation. But insiders whispered otherwise. Behind closed doors, the fear was deeper. A Treasury auction days earlier had seen foreign demand drop by 28%. Meanwhile, the 10-year Treasury yield had jumped again, heading straight for a level that, in 2024, had triggered regional bank collapses. That scar hadn't healed. This time, the stakes were higher. In a rarely publicized move, Treasury Secretary Scott Bessent held a direct call with Chinese officials. No press, no transcript, just urgency. And within hours of that outreach, the tariff rollback was complete. It didn't go unnoticed. Markets connected the dots. The story was no longer being written by Washington. It was being dictated by fear. J.P. Morgan's Phoebe White said it plainly. Washington had lost control of the narrative. What looked like a strategy smelled like panic, and panic in finance moves fast. But China wasn't the only player shifting in silence. The warning had already come from elsewhere. In February, Japan, the United States' closest financial ally, sold off $36.6 billion in U.S. treasuries in a single month. The largest dump in over a decade. This wasn't about messaging. This was survival. Japan's central bank had just ended its yield curve control, and institutions scrambled to stabilize their own markets. Selling U.S. debt was the only lever they had left. And if Japan was unloading treasuries, what would China, cautious, calculating China, do next? By March, China's holdings had slipped below $775 billion. Quietly, steadily. That marked a 30% drop from 2018 levels. Beijing hadn't made a big move, but it didn't have to. The threat itself was enough. Barclays strategist A.J. Raja issued the warning. The real danger wasn't the action, it was the anticipation, the psychology of it, the understanding that at any time China could choose to weaponize its U.S. debt holdings, and the United States could do almost nothing in response. That anxiety hit a peak on March 27th when, for just a moment, the 10-year Treasury yield touched 4.96%. The effect was immediate and devastating. Credit markets locked up. Mortgage rates blasted past 7.8%. Corporate debt spreads blew out overnight. Regional bank stocks fell off a cliff, more than 6% in a single trading day. The system wasn't shaking anymore, it was convulsing. Goldman Sachs analysts pointed to the core issue: debt servicing. With the national debt soaring past $36.2 trillion, every 1% increase in interest rates now meant an additional $346 billion in yearly costs. The math had turned hostile. The Congressional Budget Office quietly revised its projections. Interest payments, they said, would soon exceed even defense spending. In the first quarter alone, the government spent $273 billion on debt servicing, more than it spent on Medicaid. The foundation was cracking. At BlackRock, traders began to sound more than just cautious. They warned, if yields crossed 5%, the Federal Reserve might have no choice but to step in, injecting liquidity into the banking system, propping up collapsing markets, and risking the dollar's credibility in the process. Inflation could surge, the dollar could fall. Trust in U.S. monetary leadership, the anchor of global finance, could start to slip away. That sudden tariff reversal? It wasn't just policy, it was triage. A desperate maneuver to slow the bleeding, to buy time, to hold off collapse for a few more news cycles. But time now is in short supply. The Federal Reserve stands at a terrible fork in the road. On one side, it can raise rates, defend the dollar, fight inflation, restore faith. But that would crush growth, push yields even higher, choke banks, and blow up the federal budget. On the other, it can pivot. Inject liquidity, loosen policy, try to stabilize the system, but that risks a return to inflation and a deeper erosion of global trust in the dollar. There is no clean way out. The Fed's balance sheet, already bloated to $744 trillion, is under strain. In the first quarter of 2025, it posted a staggering $142 billion operating loss. For the first time, the interest it paid out exceeded what it earned. And if this storm deepens, those losses will only grow. Meanwhile, Congress argues over fiscal caps and deficit ceilings like the House isn't already on fire. Former Treasury official Stephen Ratner put it in one brutal word: triage. The Fed isn't steering the future anymore. It's just trying to stop the bleeding, forced to both backstop the banking sector and bankroll a government running out of options. But even that might not be enough. The bigger question now isn't what the Fed will do. It's whether markets still believe. Investor confidence is slipping through the cracks, and you can see it in the data. In the first quarter, German government bonds, traditionally boring, stable, safe, saw a record $76 billion in inflows, a 41% jump year over year, not because they offered better returns, but because investors were running, fleeing volatility, fleeing uncertainty, fleeing a system that suddenly feels fragile. What began as a quiet, technical shift in the bond market has now morphed into something much larger, a threat to U.S. financial leadership itself. And the silence from Beijing is only growing louder. The exits are getting crowded. And in Washington, what happens next may no longer be driven by strategy or vision, but by fear, perception, and a race to stop the clock before the whole structure gives way. The center isn't holding. In Washington, political paralysis has calcified into dysfunction. In Tokyo, policymakers are scrambling inward, shielding the yen like it's wartime. And as the old guard stalls and stumbles, the world moves on, quietly rewriting the rules of financial survival. The once sacred belief in the safety of U.S. assets is fading fast. Investors aren't just looking elsewhere, they're running. Capital is flowing into European bonds, with Germany emerging as the unexpected safe haven, the last fortress in a storm that no longer feels distant or theoretical. The dollar is unraveling, not overnight, but with a momentum that feels irreversible. The dollar index has already plunged 3.8% since January, and beneath that number lies a deeper truth. Faith is evaporating. Central banks from Brasilia to Abu Dhabi are offloading dollars, not in protest, but in preparation. They're rotating into euros and yen, not because those currencies are perfect, but because the dollar no longer feels inevitable. This is not a market correction. This is the slow-motion exit from an entire financial era. And it's not just happening out there. The threat is here. It's systemic. It's embedded in the circuitry of a global machine built on U.S. debt, dollar dominance, and geopolitical gravity that is now slipping away. Every day the fuse shortens. Every hesitation, every contradictory policy, every delayed response pushes the system closer to an edge it may not be able to step back from. By March 2025, global reserves held in U.S. dollars had fallen to just over 57%, the lowest in more than 3 decades. The symbol of stability is now a source of chaos. Once a calming force in volatile times, the dollar now sparks volatility itself. Instead of anchoring the world economy, it's drifting and pulling others with it. Washington is still trying to steer the ship, but the controls are slipping, the signals are crossing, and the passengers are starting to look for lifeboats. Meanwhile, China isn't reacting, it's building. Deliberately, patiently, ruthlessly. A parallel financial world is taking shape, one that doesn't need the dollar at all. The digital yuan, bilateral trade in local currencies, energy transactions completely outside SWIFT, infrastructure, agreements, protocols, all designed to circumvent the U.S. financial system and anything tied to it. This isn't theory. This isn't future planning. It's operational. It's happening. And the consequences are crashing into the real economy now. Start with Apple. While Washington talks about economic decoupling, Apple negotiated quiet exemptions to keep Chinese parts flowing into the iPhone 17. Not because it wanted to, but because it had no choice. Over 60% of Apple's products are still assembled in China. Nearly all of its chip packaging happens in Chinese provinces. Tim Cook didn't fly to Beijing in early 2025 for the optics, he went for survival. And what he told U.S. officials wasn't subtle. Full decoupling would cost Apple more than $21 billion and risk imploding its entire product roadmap. This wasn't about ideology. This was triage. Decoupling isn't a policy, it's a cliff. The pressure isn't abstract. It's hitting homes, wallets, families. The Federal Reserve reports that 37% of Americans can't cover a $400 emergency without going into debt. Tariffs from the previous trade wars are still lingering, costing the average household over $800 a year, and climbing. Inflation surged again in 2024. Wages shrank. Pandemic savings evaporated. Now new tariffs are poised to push prices up another 12.4%, on electronics, textiles, automobiles, and more. Essentials are becoming luxuries. 61% of Americans have started cutting back on everything non-essential just to stay afloat. The trade war meant to squeeze Beijing is squeezing Main Street, and there's no cushion left. Inside the West Wing, policy has fractured into contradiction. Tariffs are imposed, then lifted. China is condemned, then quietly accommodated. Apple is criticized, then exempted. A leaked memo from the Commerce Department reveals what many suspected: a government split in two. One faction pushes for hard separation from China, while another warns of financial collapse if they follow through. The result is confusion, disarray. Markets see a government that's not leading, but reacting, and reacting badly. The political consequences are stacking up fast. Trump's approval among independents has nosedived to 39%, dragged down by fear, instability, and a creeping sense of economic fragility. The Conference Board's leading economic index has now fallen for 14 consecutive months, flashing red for a recession before year's end. Goldman Sachs slashed its Q3 growth forecast to 1.2%. Investment is drying up. Layoffs are accelerating, especially in battleground states like Wisconsin, Pennsylvania, Michigan, where rising import costs are eating through margins and hollowing out factories. The comparisons to 2008 are no longer theoretical. They're being spoken aloud in boardrooms and back channels. The pressure to reverse tariffs is building behind closed doors, but the political cost is too high. With an election looming, no one wants to blink first, and the clock is ticking. The markets may not wait, allies may not wait, the world may not wait. Interest rate tweaks won't fix this. Selective tariffs won't fix this. These are tactical band-aids on a strategic wound. The real shift has already begun beneath the surface. China's campaign to dethrone the dollar isn't a warning. It's a construction project, a new economic architecture, one not reliant on U.S. approval, influence, or systems. Energy priced in yuan, commodities traded outside the Western framework, digital settlements governed by Beijing, a world where Washington's financial lever no longer moves anything. This isn't the showdown. This is the setup. The tariff skirmishes, the reserve reshuffling, the headline drama, that's just the noise. The real shift is happening quietly, in code, in contracts, in connections being built outside of the old system. What comes next isn't just a financial transition. It's a realignment of power, and it's already underway.